All right. So we have two topics today. One is bubble talk, and then what's taking so long with Iran. And just to get a sense of where the market stands today, uh, as of yesterday's close, the S&P 500 was up by 8.5%. Given today's market activity, we're up a little bit less than that, probably about 8.2% year to date. So that's a pretty strong return. At the peak, as of very early this week, the S&P 500 was up by 8.7%. But we've definitely seen a pickup in market volatility, and we can trace this directly to the release last week of two inflation gauges. First, we got the consumer price index, which came in slightly above expectations. And then the following day, we got the producer price index, which came in well above market expectations. And we know that those higher inflation readings were due to higher oil prices as a direct consequence of the war going on with Iran. And each time we see rumors that the war is going to start up again, we see oil prices surge higher, and that leads to higher bond yields, government bond yields, and lower stock prices. And every time we hear rumors that the United States and Iran are close to striking a deal for peace, we see the reverse of that phenomena. We see oil prices come down, government bond yields decline, and the stock market rally. Okay, this has been a cycle that has been going on actually not only since last week, but even well before that. So it's really the war that continues to drive the stock market, and the way it's driving the stock market is through that process that I just described. War rumors cause high oil prices, which cause bond yields to rise, and the stock market goes down. And the reverse, when we see rumors that the war is going to end, we see oil prices decline, bond yields decline, and the stock market goes higher. So the war continues to be the driver of the market. That seems to be pretty clear. Now, just this morning, we had a new rumor, and the rumor was that Iran is refusing to surrender their enriched uranium over to either to the United States or to a third-party country. And as a result of that, the stock market, oil prices went up again today, bond yields went higher, and the stock market has gone down. Now, the White House has been pushing back against that rumor, saying that it's not true. And we've seen a little bit of a recovery off the lows for the stock market, but investors aren't really buying it. And so at least thus far, we still see higher oil prices, higher bond yields, and a lower stock market on the day. Now, I mentioned this in yesterday's global macro note, or maybe it was in today's global macro note. I can't remember at this point. But I have never seen a market that has been so manipulated. I've seen manipulated markets, but never to this degree. And it's really because of the environment that we're living in, right? We have this war that is raging. Trump trying to negotiate, continuing to say that we're on the verge of a truce, but then the next minute reversing himself. And you see people on social media taking advantage of this uncertainty and sending out rumors that we're right about to reach an agreement. And you see the stock market, rising higher. I think that was really the main driver yesterday. The stock market was up by close to 1% yesterday. And the major driver of that move was on a rumor that we virtually had reached an agreement with Iran. And we wake up this morning and it's clear that that was simply someone spreading false rumors. And today we're seeing the market decline as investors are waking up and saying, you know what, seems like we're not on the verge of an agreement. Now, we talked a lot about, we've mentioned that bond yields have been going higher, and that's a result of higher oil prices. How does that work? Well, when oil prices go higher, that leads to higher inflation, right? And we saw that in last week's inflation data, higher inflation numbers. And as inflation goes higher, there's an expectation that the Fed is going to have to raise interest rates. And that expectation gets built into the bond market. So we see a rise in bond yields across the yield curve. So 2-year bond yields rise, 5-year bond yields rise, the 10-year bond yield rises, the 30-year bond yield rises. We saw the 30-year bond yield rise to the highest that it's been since 2007, 2008. The 30-year bond yield the other day hit 5.2%. So again, the highest it's been since late 2007, early 2008. On expectations that the Fed is going to have to raise interest rates. Now, this puts the Fed in a very difficult position. We have Kevin Warsh, who is now officially the head of the Fed. His first meeting is going to be on June 17th, where he will lead the Fed for the first time in an FOMC meeting. And remember, Warsh got this job in part because he convinced Trump that he would cut interest rates. So now Kevin Warsh is in a position where it's virtually impossible to come in and cut interest rates because inflation is rising. The bond market is telling Warsh that he probably, if anything, should be raising interest rates. And he's now in a situation where he's going to have to disappoint the president who nominated him to take over the Fed. Now, the big question here is, how is he going to handle this, right? In the last meeting at the Fed, the official statement from the Fed, the one that they release on a piece of paper, the Fed continued to have what's known as an easing bias. That is to say, that statement indicated that even though the Fed was not in a rush to make any moves on interest rates, in all likelihood, the next time they moved on interest rates, it would probably be to cut interest rates. Okay, that's what is known as an easing bias. They don't state it explicitly that their next move, eventually, when they do move interest rates, it would be a cut, but it is strongly hinted in that statement. Now, there were many members at the last Fed meeting who were against that notion that the next move should be a cut. And yesterday we got the minutes from that Fed meeting, and it's clear that there was a good number of Fed members, not a majority, but a good number of Fed members that wanted to remove that easing bias. Now, since that meeting, we got some very high inflation numbers, which we just talked about. Last week, we got inflation numbers for the month of April. So the inflation story has gotten worse since the last Fed meeting. So if the Fed was close to moving towards a neutral bias, they're going to be even closer now. So Warsh at the next meeting is going to probably face a majority of Fed members that want to remove the easing bias and move towards neutral. A neutral bias means we're as likely to raise interest rates as we are to cut interest rates. Now, they're not going to move immediately towards a tightening bias. That is a bias towards raising interest rates. Their first move would be to move towards neutral. Now, is Warsh going to push back on a majority of his colleagues who will want to remove that easing bias and move towards neutral? Is he going to dig in his heels and get to a big disagreement? And even if he does, he'll probably still be in the minority. So in all likelihood, Warsh is going to have no choice but to move that official Fed statement towards a neutral bias. And then he's going to have to stand in front of the press at his press conference and explain to the United States and explain to the President of the United States why the Fed is no longer desiring to cut interest rates. Now, normally that wouldn't be such a hard case to make, right? Inflation is rising. We've just, because of the war, we had this oil price increase. Inflation indicators are moving further and further away from the Fed's 2% inflation target, right? Normally, this would not be difficult for a Fed to do. But again, the drama here is Trump appointed Kevin Warsh to cut interest rates. And now Kevin Warsh is in a position where he's going to have to disappoint the president. So that's the drama. But a couple days ago, something very interesting happened. A reporter asked Trump straight out, will you be upset if Kevin Warsh doesn't cut interest rates? And Trump gave a very surprising answer. His answer was, I'm going to let him do what he wants to do. That's a direct quote. And then he went on to say he's a very talented guy. He's going to be fine. He's going to do a good job. So that's not the way Trump would have responded if Powell was still the Fed chair. But given that Warsh is taking over, and Trump has probably been told by Scott Bessent, his Treasury Secretary, that Warsh is probably not going to have any other choice than to move towards a neutral bias. And Trump can either make Warsh's life impossible right from the get-go or let Warsh do what he wants to do. And if Warsh, in his first meeting at the Fed, is going to be put into a position where he's getting into a fight with his colleagues are going to want to move towards a neutral bias. And if Warsh is put in a position where he's saying, no, we need to keep our easing bias, that's going to put Warsh in a very difficult, conflicted situation with his colleagues on day one. That is not the way the next Fed chair wants to start. And I'm sure, Bessent explained to Trump, you do not want your new Fed chair to be put in this defensive role, right? It's not a good way for him to start. And if you want him to eventually have the respect of his colleagues to be able to cut interest rates over the medium term, you've got to let him come to the Fed and be credible. You can't have him embarrass himself and look like he's your puppet on day one. So I think the expectation here is Warsh is not going to be humiliated in front of his colleagues. He's going to be able to go along with removing that easing bias, move towards a neutral bias, and even sound a little bit concerned in the press conference about inflation. My expectation is he'll make the argument that this is the new inflation pressures that we're seeing are entirely due to oil prices. He expects that the inflationary episode will pass, and ultimately the Fed probably will be able to cut interest rates, but it may take a little bit longer than he would have liked. That's the type of press conference I expect that Warsh will give. And I think the markets will be fine with that, and his colleagues will be fine with that. So Trump sort of removed some of the drama that we might have seen, but good for Trump that he handled the reporter's question in that way. It was a bit surprising. Now let's move on to the topic of bubble. Is the market in a bubble? So it's important to point out that this bull market didn't just start on March 31st of 2026. Remember, we had like an 8% decline in the stock market between the time of the market peak this year and March 30th, right? We had a 10% decline. And then between March 31st and essentially, a couple days ago, we had an 18% rally. So many people are under the impression that this bull market began on March 31st. And of course, everyone here knows that that's not true. The bull market actually started on October 12th of 2022. And since that time, since October of 2022, most segments in the market, most sectors in the market have delivered very solid upper double-digit gains. Okay, not triple-digit gains, but double-digit gains, up 60%, 80%, 90%. And I'm pointing this out because you hear many analysts in the market who are convinced that we're in a bubble saying that this rally that we've been experiencing is very, very narrow. But the truth is, if you look at this rally going back to late 2022, it has not been a narrow rally. It's been quite a broad rally. It's not just a few large cap technology companies that have delivered monster returns, right? It is most of the market is experiencing very strong double-digit returns, right? It's true that the semiconductor stocks and some of the large cap tech stocks, they've delivered triple-digit gains, but most sectors have been delivering very, very strong double-digit gains. Now, most of the outperformers that have been delivering triple-digit gains are associated with the AI theme. And shortly after the bear market ended in October of 2022, ChatGPT was introduced. We all learned about ChatGPT. It came into the market in November of 2022, and it was really the Magnificent Seven stocks that led the initial exuberance about AI. But along the way, semiconductor stocks soared also. And, we all know that, we own SOX, which is a semiconductor play, and that has been our top performer. And that's where these triple digit gains have been most seen in not only in the Magnificent Seven, but in the semiconductor stocks. Now, investors hope that AI will lead to widespread improvements in productivity and earnings growth. And I believe that we're starting to see this. We're starting to see, and we saw really spectacular earnings growth in the quarter that just went by. We just got NVIDIA reporting yesterday. That was the last company to report, the last major company to report for the first quarter. And I think that impressive earnings growth, I think in part was driven, just in part, and I think we're going to see more and more of this going forward, was in part delivered because we're starting to see AI being more incorporated into more and more businesses. But we're in the very early innings of this. So I think over time, we're going to see the bull market broaden further as AI technology is adopted more and more by corporate America. And this is a key assumption behind my 8,000 target for the S&P 500 at the end of this year, and my 10,000 target for the S&P 500 by the end of the decade, right? The key assumption here is that AI technology will be adopted by more and more of the S&P 500, as well as the companies outside of the S&P 500. We're going to see strong productivity growth and strong earnings growth. That's only going to get better and better over time. Now, the point I'm making here is that this is not a narrow rally. This is a misnomer that S&P 500 companies across all sectors, or at least most sectors, have seen double-digit gains. Yes, not the triple-digit gains seen by the superstars, but double-digit gains is absolutely nothing to sneeze at, and that is a broad bull market. Now, there are 11 sectors in the S&P 500 index. Okay, 11 sectors. Now, only 2 of those 11 sectors have outperformed the index. The S&P 500 index since October 2022 is up by a whopping 107%. And only 2 sectors are up more than 107%. And those 2 sectors are, not surprisingly, information technology, which is up 225.7%, and communication services, which is up 212%. Now, those are the companies that are really behind the AI industrial revolution. Now, if you look at U.S. industrial sector, the U.S. industrial sector, that is the 3rd best performer, and that's up 102%. Remember, I said the S&P 500 is up 107%. The industrials component is up by 102%. So that is also nothing to sneeze at. And when we talk about industrials, we're talking about sort of the nuts and bolts of U.S. manufacturing, companies like Caterpillar, and these big industrials in the United States. So outside of those 3 sectors, all other 8 sectors are seeing strong double-digit performance, right? Again, in the 90s, in the 80s, in the 70s, in the 60s, since 2022, which is spectacular. But they are underperformers, but they're still great gains. And that is not a narrow market advance. It's just that they are not keeping up with these whopping triple-digit gains made by information technology and communication services and even the industrials. Now, many analysts who are convinced that we're in a bubble have been comparing the current bull market to the bubble of the late 1990s and the early 2000s, right? The famous dot-com bubble. And the comparison they're saying is just like we had this unbelievably impressive stock market advance in the late 90s and early 2000s, we're having also this incredibly impressive stock market advance today. But just like that ended with the bubble bursting, today also we're seeing a bubble, and we're going to see the bubble burst just as explosively. What are they missing? Well, most importantly, they're missing something very key about current PE ratios. If we look at the current 12-month forward PE ratio, what's a 12-month forward PE ratio? It's the price of stocks today divided by earnings expectations in the coming 12 months. Okay, so the current PE for the S&P 500 information technology sector, which is the sector that's done the best in the S&P 500, that forward PE ratio is at 24.3. Okay, 24.3. That's really not that much higher above the overall S&P 500 forward PE ratio of 21.1. So it's only about 3 points higher. Information technology is only about 3 points higher than the PE on the overall S&P 500. Let's compare that to the PE ratios during the tech bubble of the late 90s, early 2000s. The spread between information technology, which also led back then, was 20 points. Again, we said today that spread is 3 points. Back then it was 20 points. So in 2000, at the peak of the bubble, the PE ratio on information technology was 47. Okay, today we said it's 24.3 on information technology. And the S&P, the PE ratio on the S&P 500 back then in 2000 was 24, right? So that is 23 points. That's a 23-point spread, right? That's a huge spread. Again, today that spread is only 3 points. The S&P 500 again today is back in 2000 was at a PE of 24, okay, compared to IT of 47, right? I hope everyone's understanding that. So back then, information technology was trading at ridiculously high PE ratios. Investors had put those stock prices to the moon, right? Today, the overvaluation is not nearly to that extent as it was in those days. Okay.
Hey Seth,
Similar, yes.
I guess this is maybe directed at my comments. But I was really curious about like when you just go and Google, the P/E ratio of NVIDIA or whatever, it's showing 45. So what are you looking at to see the 12-month PE ratio? Like where is that data coming from?
So what they're giving you when you look it up on Google, they're giving you backward earnings. So they're giving you earnings over the last 12 months.
Okay.
And that's not all that useful, right? That's the reason why that's not all that useful is because every year we're seeing earnings growth exploding. And investors are forward looking. So they don't care about last year's earning, the past 12 months anymore. They're looking forward to earnings in the coming 12 months. So it's the denominator that's different, right? They're using backward 12-month earnings. I'm using forward 12-month earnings expectations. So how do I get that number? That you get from, Wall Street analysts.
Hmm.
Okay.
So
And
it's
that's
not
real.
really publicly available or
You know what? You can, publications like Barron's will publish that. Um, Sometimes you'll get it in the Wall Street Journal. So it's available. Sometimes you can get it off of social media, but that's
okay.
really what you want it. That's really what you want to use.
Yeah, I just thought that was interesting that, it's
Yes,
showing 45, back in 23, it was up in like the hundreds. And then you're saying it's going to be, the 12-month forward is like around 25. So it's not, as dire as it seems.
exactly on NVIDIA. Yeah, I mean, 25 for a company like NVIDIA is really not that high. It's really
Hmm.
not that high.
No, that was interesting.
Yes.
Thank
Good,
you.
good question, Derek. So another major important comparison is if you look at the current combined market capitalization of information technology together with communication services. You add those two together. You add those two market caps together. What is market cap? That's the value of the two companies together. You just take the market cap is the price of those sectors combined, multiplied by the number of shares outstanding, and that gives you the valuation of the company. So if you take the valuation of the information technology sector, right, the market cap of the information technology sector, plus the market cap of the communication services sector. You add them together, that gives you 48%. So the market capitalization of these two sectors is 48% of the entire S&P 500. That sounds like a lot. And many, many people will say, look how overvalued these two sectors are, because they make up 48% of the valuation of the entire S&P 500. That's nuts. And it does sound crazy, but you've got to explore and bring it down to the next level. That is only part of the story. The other part of the story is you have to look at earnings. Well, if you look at the earnings of these two sectors, they make up 43% of the earnings of the entire S&P 500. So the fact that the valuation of these two sectors is 48% isn't that extreme if you understand that these two sectors comprise 43% of all the earnings of the S&P 500. Okay, let's compare that to the tech bubble of the late 90s and early 2000s. In 2000, the combined market capitalization of these two sectors, information technology and communication services, was 40%. Okay, today it's 48%. Back then it was 40%. So from that standpoint, you can say, wow, it's even more extreme, right? And people will say that. People say the bubble today is even worse. It's worse than it was in the 90s because the market capitalization today of these two sectors of the entire S&P 500 is 48%. And back then in 2000, it was only 40%. Okay, that sounds scary. But let's look back in 2000. What were the earnings of these two sectors as a percentage of the earnings of the overall S&P 500? Well, they were just 24%. So you see that gap? Back then, the valuation of those companies was 40%, yet they were producing just 24% of the earnings. That's a bubble. Today, there's no bubble, right? The valuation of these two sectors is 48% of the S&P 500, but it has merit because they produce 43% of the S&P 500 earnings. This is a really important point that many analysts miss. So you understand why they think it's a bubble, but they're only looking at half of the story. They're leaving out 50% of the story. And if you leave out 50% of the story, you do not have a complete picture. So these are some reasons, important reasons, and I can go on and on and on about why this is not a bubble, but we covered some critical ones. Okay. Now I want to pivot, and hopefully we've sort of reduced the concern that we might be in bubble territory. This is, I'm sure, a topic that's going to be with us. Look, it was with us for all of 2025. I'm sure it's going to be with us for all of 2026 and 2027. So we're going to be constantly revisiting this theme of why it's not a bubble. But these are just to give you sort of a different perspective on why it's not a bubble, some ideas that we haven't talked about before. Now I want to pivot to Iran and what's taking so long. And really, when we talk about what's taking so long, we have to ask, what is Trump up to? Why does he keep delaying what many people think is inevitable, that ultimately we're going to have to grapple with the fact that Iran just isn't going to cave into Trump's demands. They're not going to give up their capacity to enrich uranium to create a nuclear bomb, right? The likelihood that that happens is pretty low. So what's Trump up to? Well, there are a few theories that people have. One, of course, is, and we've discussed this, that he's got midterm elections that he needs to worry about. and he would like this war to end well in advance of those midterm elections to give the Republicans the best chance possible at winning the House of Representatives, right? They're in all likelihood, they're going to win the Senate, but the House of Representatives is at risk, and he does not, he wants to get this war over with to secure midterm, or not to secure, but to give the Republicans a shot at winning those midterm elections. And so that's one possibility. Another possibility is that just, Trump is exhausted by this war. He thought it was going to be over much sooner. He's been a bit surprised by the resilience of the Iranian regime, right? As he said over and over again, we've essentially destroyed them from a military standpoint, but these guys aren't surrendering. And, he's just looking for an off ramp. He's exhausted by it. He's worried that the high oil prices are going to eat away, not only cost the Republicans the midterm elections, but gradually eat away at his support base, his MAGA support base. And, that might be a concern. These might be very realistic concerns that Trump has. I'm not convinced that those are the reasons. There's another theory that I've heard just in the last day, which I find very interesting. There is if you're in like an insider in Washington, D.C., they're talking about something they call BATNA, BATNA, BATNA. And BATNA stands for better alternative than a negotiated agreement. So what does this mean? This means that Trump and Iran, neither side really wants a negotiated agreement. This is a game they're playing. They're pretending that they want a negotiated agreement, but they actually don't. This is just the dance they're playing. So what is the better alternative than a negotiated agreement? The better alternative is not necessarily a return to war, but it's a continuation of what we've been doing since April 8th, which is we maintain our naval blockade because we think it's strangling them economically. And ultimately, it weakens Iran more and more and more. It degrades the regime's credibility. As the economy suffers and enters a deeper and deeper recession, the regime loses its capacity. They don't care about the population. They could care less about their population, but they lose their capacity to continue to pay their soldiers in the IRGC and in the Basij, right? The Basij is the paramilitary group. And if they can't pay them, then ultimately there's a risk that the IRGC and Basij turn on the government. And that is the BATNA, the better alternative than a negotiated agreement. You just drag this on and on and on. And from Trump's standpoint, he has until eternity. Right? This is just a theory, and it goes against this idea that, about midterms and Trump being exhausted and he's worried about the MAGA base. No, this argument says Trump doesn't really care about the midterms. And in fact, with the redistricting that's going on, the Republicans have a decent chance at holding on to the House in midterms. And the high oil prices that everyone said was going to bury the U.S. economy, not true. The U.S. economy seems to actually be accelerating, and the unemployment rate remains very low. So Trump isn't all that worried about the economy. These dire projections that the economy was going to enter a recession is just not happening. And if oil prices just sort of stabilize at these levels, inflation's not going to keep going higher and higher and higher. Inflation may just sort of stick here for a while and ultimately go down. So Trump is in no rush. What about the Iranians? The Iranians are also playing the BATNA game. They also don't want a negotiated agreement because they want to hold on to their enrichment. They want to hold on to their ballistic missiles. They want to continue to hold on to their proxy network with Hezbollah and Hamas and so on. And they believe that they truly are winning, not necessarily winning militarily, but winning from a popularity standpoint. Not that they're winning the popularity contest, they're not, but they could care less if they're unpopular in Iran. What they're trying to do, and they think they're succeeding, is they believe Trump is becoming less and less popular, and they think he will fatigue. And ultimately, they think Trump will seek an exit ramp and basically surrender and give them a very, very cushy agreement, just like Obama gave them a cushy agreement. They think time is on their side. So neither one, according to this theory, wants an agreement. And they're going to continue to dance this dance forever and ever and ever. So that's a second uh, idea of what's taking so long, a second theory of what's taking so long. Now, there's a third theory. In this third theory, I want to go into some depth because it's the one that I think is the most concerning. The third theory says, no, Trump really does want to end this. And it's not because of midterms. It's not because he's exhausted. But we have a very serious military problem. We have a very serious military problem. The problem is we are running out of munitions. And this war has created a huge problem because we've used up so many of our munitions that we do not have enough if China were to attack Taiwan. And Trump's got to save what we have left over. So he's got to get out. He's got to end this thing because, God forbid, if in a month China decides to move on Taiwan, we're in trouble. And he's got to save up for that. Now, this is a very bad argument because this war against Iran didn't last very long, right? It lasted from February 28th to April 8th. So it lasted about 40 days where we were firing. So after a few weeks, this argument goes, we've exhausted so many of our munitions that we're not ready for China. The reason why this is such a bad argument, how long does anybody think a war against China would take? It would take months and months and months, if not years, right? Typical war takes years. If the two superpowers are going to go at it against each other, it's not going to last weeks. It's not going to last months. It's going to be very protracted. It's good. And if we think that 40 days of munitions, a few weeks of fighting, put us in a terribly vulnerable position to wage war against China, if that was the case, we were in a vulnerable position already, right? A few weeks of munitions is not going to get us through a war against China. So the truth is, the war against Iran didn't create a problem. It exposed a problem that already existed. It already existed. And this is a lesson that we should have learned already. If we were short munitions going into this war, it should have never happened. US policymakers in the Biden administration should have studied the example of Russia and Ukraine and saw how long that war went on for, right? And realized that Russia had a munitions problem. And if we had a lengthy war the way Russia had against Ukraine, we would also run into munitions problems pretty quickly. But they didn't learn the lesson. What was Ukraine able to do against Russia? They were able to wage low-cost warfare using low-cost drones, low-cost missiles. So it didn't matter that Russia had more sophisticated weaponry than Ukraine. As long as Ukraine could continue to produce low-cost weapons at a rapid rate, they could compete with Russia. And the Biden administration just remained blind to that problem. Not the Trump administration, right? As soon as Trump became president, he started talking about the need to increase spending on our military and to increase output of missiles and other low-cost weapons. And he's trying to do something about it. The problem is he's running into a very difficult congressional process where the Democrats are digging in their feet and making it very difficult for Trump to increase expenditures on our military. Trump is trying to push through a 1.5 trillion military budget, which would be the largest budget that we've had since the Bush administration. Under Democratic administrations, we had major shrinking in our spending on the military, and it's put us in a very difficult environment. Both Obama and Biden shrunk military spending drastically, and that's why we are in this situation. Now, it's true that America and even Trump do not want long wars, right? We don't want long wars. Who wants a long war? But the mistake we made is because we didn't want long wars, we created a military that is incapable of fighting long wars. That's a problem. We tailor-made our military capabilities to a fantasy world, a world that's not reality. Because in the real world, if your main threat comes from China, and no one disagrees with that, right? Everyone agrees that our main challenger, our main rival in the world is China. And no one could possibly argue that a war with China is going to last a couple of weeks. And yet we created a military for this fantasy of a short war. It makes no sense. Our military planning made no sense. Now, what do you need in a short war? You need highly sophisticated, highly precise weaponry. And we have the best, most sophisticated weaponry in the world. And that's great. But the problem is we shortchanged low-cost missiles that we could produce on a mass scale. And when you're in a protracted war, a long, long war, yes, you need the most sophisticated, most expensive weaponry that's capable of highly, highly precision strikes. But you also need the low-cost things that are necessary to endure over the long run. Now, when you have this high-end, exquisite weaponry, alongside it, as I said, you need less capable weapons that can still blow things up. You need both. And we only have the expensive stuff. So we use the most expensive, sophisticated Patriot missile for easy jobs, jobs that you could do with a low cost missile. So just to make this point crystal clear, if you have two cars, you have an unbelievably exquisite Ferrari, and you also have a pickup truck, right? Are you going to take your son and his friends to their hockey game in your Ferrari? Or are you going to use the pickup truck? You're not going to drive your son and his buddies with their smelly hockey skates and equipment in the Ferrari, right? It's not going to happen. It wouldn't be smart. But that's what we're doing. We are using our Ferrari to do the easy stuff. And that's why we've got a problem. The same thing is occurring on missile defense. So we have some pretty sophisticated defense systems, but because they're so sophisticated, we're not really ready to share it with everyone in the Middle East. because it's so expensive. But we don't have a simple defense system, right? We left out a simple defense system, and therefore we left countries like the UAE, the Saudis, and others sort of in a bad position. We need to dumb down our military, do the sophisticated stuff, but we need mass production to be able to do the simple stuff for protracted periods of time. So, um, that's where we are. That's where we are in a military standpoint. Now, does that mean that we need to end this war now? It doesn't mean we need to end this war now. We still have a healthy stockpile of weapons, and if we return to war, we're going to have to unfortunately use more of it up. And it does take time to produce the sophisticated stuff, but that doesn't leave us any more vulnerable against China than we already are. We entered the current conflict in a bad position against China. If we're going to go to war against China, right? Because we are incapable of fighting a war that lasts more than a short period of time against a superpower. And that's going to have to change, and it's going to have to change fast. And the Trump administration seems to understand that. But we're vulnerable against China today. We were vulnerable against China before this war with Iran started. And we're going to be vulnerable against China 6 months from now, regardless if this war starts up again or not, because we can't last in war because we don't produce in mass all these sophisticated weapon systems. It's not hard. It is not hard. We just need to have the willingness and put the money behind it, right? If Ukraine can do it, they can produce simple weapons on mass scale. We can surely do it, and we can do it in far more mass than Ukraine can, because we have better industries, we have better companies, we have better defense companies, we have a heck of a lot more money. So this is just a question of will, and and the problem here is that we still run up against a difficult Democratic Party who does not like to spend on defense. It's a problem, and therefore, obviously, these midterms are important, right? They're not irrelevant because we need congressional approval to push through this $1.5 trillion budget, military budget. Now, going back to the war, a couple more minutes left. In going back to whether Trump is going to strike again or not, and you can see his incentives. His incentives for looking for an exit ramp, they're not small. I understand them, but Trump needs to take his legacy and his current standing with Republicans very seriously, and I think he is. But if he were to continue with this post ceasefire pattern of making bold red lines and all these very serious threats, but if he keeps retreating, ultimately I think his legacy is going to suffer, because I suspect that even though we're going to weaken the regime economically by maintaining the naval blockade, it will not finish the job. And ultimately, what will happen is the regime will outlive Trump, right? If Trump does this until the end of his term, which, it's not inconceivable. I think it's unlikely, but it's not inconceivable. And you end up with a different president. If it's not Marco Rubio, I think Marco Rubio is probably the only candidate from either party who would be willing to finish off the job. Trump's legacy will be someone who actually didn't finish the job. And I think that will damage him as time goes on, even within his MAGA base. People want the war to end in the MAGA base, but they want it to end with a clear victory. And if Trump doesn't deliver a clear victory, he's going to look like he took the exit ramp too seriously. And I think he won't be able to escape the taco label. Trump always chickens out. I think it will haunt him for the rest of his presidency and the rest of his life. So um, I think that ultimately that's where we're going to end up. Uh, I think Trump may give the Iranians a few more chances uh, at a deal, but ultimately, if they remain stubborn as they have been, and I think there's no reason to believe otherwise, Trump is just going to have no other option other than returning to war. And in addition to returning to war, if he really wants to finish off the regime, there's only one way to do that, and that is to give true support to the 80% of the Iranian people who want to topple this regime. What does that type of support look like? It, number one, we have to figure out a way to open up the internet, because right now the people can't communicate with each other. And I know we've used Starlink to a very limited extent to allow for communications, but we probably can open up their ability to communicate with each other far more with Starlink than we've done thus far. If the opposition can't communicate with each other, they can't be very effective in taking to the street. And secondly, uh, looking for ways to arm the opposition. We still run against this problem where you have an armed IRGC, an armed besiege against a totally unarmed population. I do think we are seeing continued signs of not necessarily of outright regime disloyalty, but of conflict within the regime. We're hearing reports that people within the Artesh, which is the regular military within Iran, they are showing some signs of discontent. There have been apparently some clashes to a minimal degree with the IRGC. Those stories are leaking out. But the more we arm the Iranian people, the more likely you could get splits within the army, within the military, and taking to this, encourage them to take the side of the people in the streets if they see them armed. They might believe they have a fighting chance. So we need to strike Iran again, equip the people with military, give them an internet, and perhaps helping them with planning. We know the CIA and the Mossad are capable of doing this. The question is, are we serious? Are we going to get serious about helping them? Because the bottom line here is, as long as this regime survives, they will reconstitute themselves militarily. They'll reconstitute. We may have pushed them back by several years in terms of their ability to get a nuclear weapon, but if they are left standing, we know that they will be back at it, and they will arm themselves with missiles. They will they'll be very ambitious with their obtaining nuclear capability, and they'll return to the danger that they were prior to this war. A danger to the United States, a danger to the Middle East, a danger to the world. So I think Trump understands this, but with the mixed messaging, you can never be so sure. So we're operating on guesses, sometimes educated guesses, sometimes less educated guesses, but that's where we are. So let's take a pause and see if anyone has any questions.